we see even higher prices over the next 6 to 12 months, driven by greater investment demand alongside a drop in U.S. real rates, a seasonal recovery in jewelry consumption, and ongoing central bank purchases. Overall, we recommend an allocation of around 5% to gold within a balanced U.S. dollar portfolio and stay most preferred in our global asset allocation.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. It's Monday morning. I'm Vince Lanci. Today's market rundown. We will go through the UBS target raise and why we feel it's important. Let's start with the markets. The dollar is 100 spot 32, down 8 points. 10-year yields are up a basis point at 376. S&P 500 is 57.30, unchanged bid. The VIX is 1707, up small. Gold is 26.37 on the lows pretty much of the evening, down $20. Silver as well, 31.15, down 46 cents. Copper was higher, 453, but it's now down 2 cents. So copper was very strong last night, and although gold and silver were strong, copper was very strong. So it seems like everything is turning on copper right now. All right. WTI down 78 at 68, 78, 77, 76, 78. Natural gas 265, very strong, but unchanged at the moment. Bitcoin down almost 2,000 at 63,600. Ethereum 2,600. Platinum, palladium are both down $15 and $18. Palladium down 15, platinum down 18, 996 and 982. Grains are probably also down. They're mixed, violently mixed. Wheat is up 1% at 588, and soybeans are 1068, down 1%. Corn is unchanged. Taking a quick look at that. This is probably at least partially tied to what went down in Japan. The election was, let's say, unsettling for the Japanese stock market, and there may be other news coming out about China. We'll look into that in a minute. But let's get to the stories. All right, there's the front page. Committed traders report, why are gold swap dealers not very active? We'll discuss that in a second. Is gold in a bubble? This has become very popular, and I think it's a question everyone has been asking themselves, and we asked ourselves and answered for you publicly. All right, why the UBS target raise is important. First, let's do the UBS target raise. Some people are talking about it, and we had it out 3 days ago. But here we go again. They raised their target to 2,750 by end of 2024 from 2,600. They raised it to 2,850 by mid-2025 from 2,700. And they raised it to 2,900 by end of Q3 25 from 2,750, raising it $150 across the board. Here's a quote from the report. Gold has risen 29% this year, consistently breaking records on the way up. Meanwhile, the metal has risen above our long-held year-end target of US dollar 2,600 an ounce, ahead of schedule. And according to the World Gold Council, it has historically rallied as much as 10% in the 6 months after the Fed cut. Quickly, this chart. This is their chart. I think the key part is not in this chart, but we'll touch on that in a second. Continuing with the report, as such, we see even higher prices over the next 6 to 12 months, driven by greater investment demand alongside a drop in U.S. real rates, a seasonal recovery in jewelry consumption, and ongoing central bank purchases. Overall, we recommend an allocation of around 5% to gold within a balanced U.S. dollar portfolio and stay most preferred in our global asset allocation. Before we move on to why it's important, I want to give this a little bit of context. A drop in lower U.S. real rates, that is the current catalyst that everyone's model has. So rates are lower, ostensibly, the dollar should weaken, and that will drive gold higher. A seasonal recovery in jewelry consumption, that refers to the Far and Middle East. China's Golden Week, Diwali is coming up. We're getting into jewelry demand, wedding season, et cetera, et cetera. Ongoing central bank purchases, that's been the reason gold has rallied as much as it has thus far over the last 2 years. Overall, we recommend an allocation of around 5% to gold within a balanced US dollar portfolio. All right. Please understand that their client base is wealthy, conservative individuals and large pensions. This may seem tepid if you're looking for a 3,000 an ounce recommendation, but a couple of things to keep in mind about UBS. Number one, they're conservative. Number two, they were calling for 2,600 well before everyone else was calling for 2,500. Next, Europe is undergoing some changes with regards to its perception of gold as an asset to be held in lieu of bonds in pensions. So when you say something that sounds tepid, like we recommend an allocation of around 5% to gold within a balanced US dollar portfolio, you're speaking to pension fund managers who have zero gold, have euro bonds and euro stocks, zero gold. Okay. The market is going to change, which brings me to why it's important. The full analysis can be linked, is linked right there. Now, why it's important. First of all, I want to be completely clear about this. This is not a reason to go out and buy gold if you're a client. This is a reason to stay chill and not do anything. This is not a short-term buy recommendation. This is a raising of the target carefully and conservatively, because you're not in the business, as UBS is not, of inflating expectations. Okay, but the 5% comment is not something they normally say publicly, so we'll give you a little bit of a meta-analysis. We believe Western Europe is now buying gold. And I don't just mean banks. I mean pensions. I mean individuals. This is a nation movement, not just a recommendation, a movement to diversify out of EU bond risk and replace a portion of it with gold. We are definitely ahead of the curve on here. After recommending gold, and here's why. After recommending gold to Swiss pensions, the WGC is now recommending it to Ireland direct contribution pensions. The WGC, their report is linked there, came out recently and just said outright, Swiss pensions should be putting money into gold instead of bonds, period. And they gave the reasons, historical data, as well as forward-looking analysis, and it was accurate. WGC doesn't generally do that, at least not without consulting other supranational entities. And I don't say this conspiratorially. They're a big picture organization. And a week later, they're now recommending it to Ireland direct contribution pensions. You may say, oh, Ireland, who cares, right? You should care, because Ireland's outside of the main sphere. They're circling Europe. Switzerland is already gold oriented, but they're not part of the EU currency. Ireland, smaller, but they're also direct contribution pensions. They're telling individuals to tell pension fund managers that we want gold. Okay, so WGC is picking countries in Europe and saying you should buy gold, not bonds. You should buy gold, not bonds. UBS is now saying vocally, you should put 5% of your money into gold. It's almost like, and I say this in a protective way, it's almost like these entities are trying to prepare or protect their pensions for the tsunami that will come, engulfing possibly their bond market in its current environment. Anyway, this is a marketing trend and will work its way into the Euro bond market's heart. Dominoes are starting to fall. This is very early in the game. This has nothing to do with what's going to happen today or tomorrow or next week. But this is a grassroots demand being, what did I say? The ground is being beaten to get the people awake. Well, this is what's happening. Europe is finally selling its own bonds. Okay, next. That's our take on it. And on these things, we've had a pretty good track record in seeing them. Okay, news and analysis. UBS raises gold targets, remains negative on palladium. We mentioned that. That's that report. Is gold in a bubble? Also mentioned commitment to traders report. Why are gold swap dealers not very active? A quick comment on that. Gold swap dealers seem to be acting less and less on principle and more as agency. So in rallies, their market share of the selling has decreased markedly, and in sell-offs, their market share of the buying has increased markedly. So they're in risk-off mode. Uh, some of them probably are a little bit scared. Most of them probably are just being disciplined and being careful going into the events. As long as the market remains orderly, it's okay. They can do that. Their agency as well as principal. But they've had their principal trading cut back markedly. Hartnett remain long bullion and bonds as I'm so bullish, I'm bearish. He's already long bullion. He's talking more about bonds here, but nevertheless, it's an interesting analysis as he's looking at uh, how the market will evolve going forward. And it actually comes down to this week's payrolls. Moving on, data on deck. This week, a lot of PMI stuff, PMI. That's related to manufacturing and services and economic data. Are we doing well? And they're probably going to come out well. And then the final one, the one that matters the most, is U.S. employment report on Friday. Hartnett has something very pointed about that. Below 50,000 on payrolls versus above 250,000 will be interesting inflection points for the market. And we have also attached the Irish DC pension portfolio. It's a fascinating little report, and we think it's almost a template for what's going on now. WGC. The Swiss should put their money in pensions. Ireland, Irish should put their money in pensions. I mean, who's next? They'll never strike at the heart, whatever the heart is. What is the heart? Basel, uh, Brussels. I don't know, but the heart is it's like an encircling mode. Gold is encircling Europe now, like ready for a pincer move. Who the hell knows? All right, let's check back in the markets. We haven't looked at the chart yet there. Okay, quick comment about gold and silver. You can look at the price action. I'll give you an hourly chart there. Please understand that the first margin raise, which we got last week for precious metals, is not the only margin raise. They'll do it again if the market makes new highs. They're doing what they can to keep the market stable, to reduce volatility. And when they do that, initially a market rallies. That's the market that has rallied will rally a little bit more when margins are raised, and then it will sell off. Now, between this and whatever else is going on in the world, and I'll check on that in a second, uh, we'll check on China. This market is rolling over, and it's rolling over like it has been, higher highs, some funds. It is sell season, right? And so you have constant selling this time of year by macro discretionary, not a lot, but some regular hedge funds. CTAs, no, they're not, it's not sell season. They're just buying more, right? So you have strong hands to weak hands, so to speak, and we're getting dips, but you're not getting $500 dips. You're getting three buyers underneath the market. You're getting uh, some people that are trading the election. I think it's crazy to do it at this time, but okay, fine. Some people that are related to BRICS banks that are buying dips, and you have the bullion banks are buying dips aggressively now, and you also have shorts that are in the market buying it. So this market should roll over a little bit. Let's see what happens as we approach October 22nd, but expect new measures to be taken to keep a lid on rallies and to keep this market, quote, orderly if it does get up to close to $2,700 again. Quickly looking for a reason for the market moves. Well, the Hang Seng is up again. China stocks are incredibly overbought short term, but not overbought at all, considering the anything we need to do, we will do Draghi moment that China is doing. The Nikkei slammed down 5%. Uh, The only thing I could say about commodities being sold off might be that the China stimulus is working its way out of commodities and into equities, but it's too early to tell. But you take a look at the equity markets across the board, and the Nikkei sell-off is a reflection of their election. The Hang Seng, that's Hong Kong, is up because continued euphoria and proper optimism for what China is doing for their markets. All right, I'm Vince. Have a great day.
Thanks for watching this morning's Markets and Metals with Vince Lanci, brought to you each day by Miles Franklin Precious Metals, where this week's specials include 2024 American Silver Eagles for only $5.25 over spot, and 1 ounce gold Argo Heraeus Dragon bars for only $69 over spot while supplies last. Find out more, send us an email at arcadia@milesfranklin.com or call us at 833-326-4653. And as always, thanks for watching. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.